Alright, so what we're going to do now, we're again starting to tread into familiar territory as we start looking at inventory. So now again, it's hopefully a user-friendly topic. And I got the supplement because we're going to use that to so that we can look at perpetual inventory in more detail. So we're now going to get into the inventory. You know what inventory is. We're going to first start by looking at perpetual and periodic inventory systems. And we'll spend most of the day looking at the various cost flow assumptions. We're going to use this later, by the way, to do that. So if you don't have it now. All right, so let's take a look at inventory basics. Let's do the basics first. And we should know that when you look at total inventory, it's going to be the sum of various prices times quantities. So that's kind of easy in a way. We'll talk about where we get those numbers from. But the question then becomes, how do you allocate the unit cost to the units in any inventory and the units sold? And then later in this chapter, we'll talk about how do you deal with the impairment of inventory when it's obsolete or slow moving. So first, let's get the quantities. So when we look at the quantities, we know that we're going to be dealing with either a perpetual or a periodic inventory system. And our focus will be on perpetual. There's a periodic example in the notes that you can look at just to refresh your memory. But we're going to focus predominantly on perpetual. And in a perpetual inventory system, just think about buying something in a department store or working in a department store. First, the inventory comes in. It's received on a loading dock. Somebody's there with a scanner. They scan in all the inventory. That is immediately recorded. Someone then goes to the cash register. The salesperson will look up on the screen, find out where the inventory is, if it's in stock or where they can get it for you. If they sell it to you, they scan it out, and it's taken out of inventory. So on a perpetual inventory system, we have a continuous update of inventory levels. Anytime a unit is purchased, it goes into inventory. Anytime a unit is sold, it comes out of inventory. Sales are recorded, cost of goods sold is updated, and you have immediate records. The other system is the periodic. And on a periodic inventory system, so this is going to be we talk about continuous. We're saying that every time inventory is purchased or sold, inventory is updated in the records. Every single transaction. Right. So every transaction updates the inventory records. Updates the inventory. So you've got a continuous balance. So you always know the balance of inventory. You always know your sales. You always know your cost of goods sold and your gross profit. On a periodic system, inventory is only updated at the end of the period. Whether that period is a month, a year, weekly updates, whatever it may be. So at any point in time, you don't necessarily know what's in inventory. And the only way that you will determine inventory and cost of goods sold is to go through that cost of goods sold formula. So under a periodic system, the only way you can determine ending inventory is by a physical count, and the cost of goods sold is going to be derived. So you got beginning inventory plus purchases, which you've recorded. That's goods available for sale. subtract out the ending inventory, which you determine by a physical count, and that will give you the cost of goods sold. Now that is unrealistic, we know, but sometimes companies will use a hybrid system, as I tell you on the next page, where they control inventory with a perpetual system and they use a periodic for financial reporting. That is possible. But for the most part, we're going to focus on perpetual, because that's the system that you will see in practice. And you all should have seen this idea of cost of goods sold being calculated that way. All right, now, we have a question. And that question is, we talk about physical count of inventory. If you have a perpetual system, does anyone know if you still have to physically count the inventory? If you got a perpetual system? Yes, you have to. By audit standards, you have to. You have to. And when you take auditing, you're going to find out about a lot of scandals that took place where the auditors were told that there was warehouses holding inventory, and they would give you warehouse receipts that verified that the inventory was there. So the auditors were working with, and this is years ago, where the auditors were working with only documents that said the inventory is located at a certain warehouse, wasn't there. And from now on, from that point on, physical counts of inventory are required. Now, when you have a perpetual system, the good thing is that you know where the inventory should be every day. You know how much should be there, and you should know the location. So even back in my day, there were computers, and what we would do, and our clients were using perpetual systems, we would count the inventory not on one day, but in cycles. So we would call the office, let's say in San Francisco, and tell the auditors to send one person out to a particular location on the third floor of the warehouse. This is the shelf we want you to count. They'd count that shelf, report it back to us, and we would then compare it to the perpetual record. And those were known as cycle counts. So you would count the inventory every single day and compare it to perpetual records. And the client didn't know where you were going to count the inventory, so that you had a way to be sure that there was no improprieties with the records. So we were able to test the client's records by physically counting every single day. And those are known as cycle counts. And that means that you can count the inventory in small pieces instead of doing it all at once. And a lot of you may have worked retail. I'm sure you still do a very large inventory, right? If you've been there, you know that. And by the way, do you count every location? No. The auditors will pick certain locations to go out and count. And during those counts, the auditors don't really count anything. The auditors will observe. We observe the procedures, we observe the internal controls to make sure that the counts are correct. Make sure you keep control of, you're probably doing it with an iPad, so keeping control of the inventory sheets that are on the iPad or the electronic device. So you have to count, whether it's perpetual or periodic. But under a periodic system, this is really the only way to come up with that number. So it is unrealistic. So sometimes you see a hybrid system, but our focus will be on perpetual. Now, the other important point, that's how you get your quantities. So you get your quantities either through a real-time system backed up by a physical count or by a physical count. The unit cost or the unit price. So we know that the cost, and this is going to be similar for a lot of other assets. It's going to be the invoice or production cost plus, that term is important, what we call reasonable reasonable and necessary expenditures to have the item in its existing location and ready for its intended use. So very important to see that idea that these are the expenditures we need to have the inventory in its existing location and ready for its intended use, which in this case, its intended use is sale. Now, what's reasonable and necessary, the FASB tells us a few things, but it could be somewhat subjective, what's reasonable and necessary. So there is some discretion. So for example, here's what the FASB tells us. And this again, you're going to start seeing more and more of this. This is the codification, that's where you would find this. I think I put on Blackboard access to the codification, so you don't really need it for this semester. You might need it for an accounting research project or another course, maybe even in finance or in strategic management. You have access, you have free access to the codification, and that tells us inventory should not include or what is not reasonable and necessary. So don't forget, if you buy the inventory from someone, you got an invoice cost. If not, you produce it yourself. Managerial accounting, what do you got? Labor, materials, and overhead that go into the inventory. Now, when you look at what is reasonable and necessary, the FASB says that we should exclude anything that is due to idle capacity, abnormal storage, rehandling, double freight charges. And the theory is, there is normal spoilage, by the way, right? So you expect certain waste. If you're building a cabinet like this, you know that there's going to be some waste on some of the material. There'll be some evaporation in certain products involving liquid. So that is standard. But if it's abnormal spoilage, if it's idle capacity, if it is rehandling, so double freight, meaning that this happens a lot in the auto industry. I don't know if you ever noticed that sometimes a local car dealership, if they're not selling enough vehicles, they have to take a certain amount from the factory. Where do they put the other cars? They'll lease empty lots, they'll lease warehouse space, and all of that as they move the cars from one location to the next, that's all due to inefficiency. It has nothing to do with the actual process of buying and selling product. So that is inefficiency does not meet the definition of an asset under this concept statement that we covered back in the conceptual framework. It doesn't have future economic benefit. So if something doesn't have future economic benefit, it is not an asset. So inefficiencies, waste, abnormal spoilage, that should not be added to inventory. What could be added to inventory is the first transportation, maybe packaging. So in many cases, when a corporation or a retailer buys products, they'll buy them in bulk and then they'll repackage them. And that's how they would sell them. That repackaging is part of the inventory cost. The transportation to the original seller would be reasonable and necessary to have the item in your store and ready for sale. So that's the logic that we have to use. Now, is it sometimes difficult? Yeah, I'll give you an example. One of my clients was manufacturing their own product, and they had some type of maintenance to be done on this machine. And they said, well, the maintenance is part of overhead, and therefore the overhead goes into products. Right? Does that make sense? Right? So you're manufacturing a product, your labor, materials, and overhead. Part of your overhead is maintenance. The problem was they didn't maintain their machines for several years. They neglected to do so, and they had a major overhaul. That was considered to be abnormal, and we expensed it. We won't allow them to put it into the inventory. So it has to be something that's reasonable, necessary, and has future economic benefit. Now, you will not be dealing with this problem now, but you will as auditors, you will as managers, you will see this in the business environment. But any asset, even a plant asset, will be the same. What's reasonable and necessary to have the asset in place? And we'll see that next chapter. So you buy a machine, you got to pay transportation. All right, that makes sense. What if you bring the machine in and it doesn't fit, and you've got to knock a wall down and rebuild it, is that part of the cost of the machine? If you need different electrical wiring, is that part of the cost of the machine? And it is, as long as it's reasonable and necessary to have the asset in place and ready for use. Right? General concept, we'll see that again. Now, what we're going to do, what our focus in this chapter is going to be, or one of the focus areas, will be the allocation problem in inventory. And again, it's important for manufacturers, retail, wholesale type companies. And the question is, how do you allocate the cost of inventory to the units sold and the units that remain on hand? And just to give you an example, going back to the accounting equation that we looked at a little bit in chapter 4, let me just try to give you a visual or a picture of the problem and the resulting problem. So let's say we buy inventory of $50,000 for cash. We debit inventory and credit the asset cash. And when we sell the inventory, let's just look at the entry for the sale. You would debit cash for 70 and we credit sales for 70. So the net inflow of cash here is 20. Now, this is a picture that you may not have seen before. Cost of goods sold. The amount that I charge for the cost of goods sold is going to depend on what? The inventory method that I use. Do I use average cost? Do I use specific identification? Do I use FIFO? Last in, first out. So this number is going to spin the gross profit. So let's say I use a method where the cost of goods sold is 40. So I'm going to debit the cost of goods sold. I'm going to credit the inventory for 40. I got a balance of what? 10. Right? I got 50. I sell 40. I got 10. Gross profit's 30. What if I change my inventory method? And the inventory method I change to tells me that the cost of goods sold is 20. So now I'm going to debit cost of goods sold, credit inventory for 20. Now my ending balance is 30. And what happens to my gross profit? It goes to 50. So the key point is that cost of goods sold is driven by the accounting method. And the other most important point, any cash flow, if we ignore tax. Is there any cash flow in the cost of goods sold entry? Well, it's in the cash column. No. So the cost of goods sold does not drive cash flow. The only cash flow here is the purchase and the sale. So the cost of goods sold is really a non-cash expense in a sense. But the point to show you is that the method that we use will actually be a determinant not only of any inventory, but the cost of goods sold. To show you this in another picture, and we're not going to do the example, we're going to use the example in module 2, because that's going to be perpetual. But just take a look at the, small so you can see it, all on the screen at the same time. Take a look at this idea of the inventory allocation problem. And the inventory allocation problem, the way I like to look at it, the diagram may be different in the books, but I like to look at it as a scale. So these are your inputs, beginning inventory plus purchases. These are your outputs, ending inventory, and cost of goods sold. So let's say we start the year with 1,000 units at 2, and then we have a series of purchases or production. So I've got inflation built in. I got 6,000 units at 3. I got 4,000 units at 4, 2 at 450, and 3 at 5. So now I've got another 15,000 units at 58, and the total available for sale is 16,000 units at $60,000. The question is, how do I value ending inventory, and how do I value cost of goods sold? Let's say I go out and I take a physical count, or the physical count will back up my perpetual records, and it tells me that I've got 5,500 units in ending inventory and I sold 1,050. What's the cost? What's the allocation? How do you allocate the $60,000 to ending inventory and cost of goods sold? That will depend on your cost flow assumption. Now, can you specifically identify the units? So do you really, can you identify the 10.5 that was sold, the cost of the 10.5? Can you do that based on today's technology? Absolutely. So I can get an exact, just by the barcode that I zapped, I know exactly what my cost of goods sold should be, and I know exactly what my ending inventory should be. I may not want to use that number. I may want to get a different result. That's why I like to use LIFO, or I like to use average cost, or I like to use FIFO. And just remember, out of those 5,500 units, where did I get them from? Did I sell 2,000 at 2, and then another 3,500 at 3? Did I take an average? Did I sell 3,000 at $5, and then 2,000 at $4.50, and 500 at, how did I build up the units sold then? I mean, the units left over, I should say. Or where did I sell the units from? So this will depend on the cost flow assumptions. Now, the cost flow assumptions will, this is another way to look at it, cost of goods sold formula is the same thing. You're getting inventory purchases, goods available, how do you allocate it? So that's the inventory allocation problem. And of course, if constant prices are the case, you don't have an allocation problem. In other words, if you only have one price, and that price never changed, you don't have an allocation problem. But with changing prices, then you've got to make a decision. So do you use specific identification? You can definitely use it because you've got the ability with technology. Years ago, they would say, well, the only place that you can use specific identification would be at an auto dealership, because I've got the vehicle identification number. I know exactly what car I sold, I know exactly what my cost was, and therefore I can determine my cost of goods sold. I can go out into the lot, I can look at the vehicles I have, get the VIN numbers, and I know the exact cost. But today you can use specific identification. You may not want to, particularly, and by the way, that's preferred by IFRS, so IFRS prefers specific identification, if you can use it. But most companies will employ one of the three, and maybe all of the three, GAAP cost flow assumptions. And those are weighted average, FIFO, and last and first step. Now, there is an illustration here on the periodic inventory system. We're going to move to module 2 in just a second. This is periodic. You can use it as a refresher if you want. But I'm going to go through a more elaborate example now because we need to cover, and you probably, I'm not sure what you covered in intro, if it was perpetual or periodic. So I'm going to show you both, but the focus is on perpetual. Most clients and most textbooks and CPA exam is going to be really based on the perpetual inventory system. So if you just came here with any one of these, anyone else, this is going to be easier to follow. Anyone else? Here we go. All right, so we're going to use this as a guideline, and then we're going to go into module 2 to do the example. Okay, so we're going to do the example of module 2. So first, take a look at the handout I gave you. And I decided to put this on Blackboard as a kid. But I want to talk to you a little bit more about the inventory valuation methods. The first and most important piece of this is that all of the methods will be assigning a cost to current units. What you can't do is think that something like LIFO really says that the inventory is the oldest inventory. Not true. Your inventory is current, but you assign old cost to it. So there's no, I can't think of, and we'll talk about this in a second, but it's very hard to imagine a company that sells its newest units first. because you've got style change, obsolescence, spoilage. So you've got to sell the oldest first. But the methods will assign costs to current units. So all the units are current. All of them are current. They're the newest ones you bought for the most part. And I'll give you some examples where that may not be the case. Let's take a look at the three methods. So the weighted average method under a periodic system, which I said you could review in Module 1 if you wanted to, or, as we're going to see as well, is a moving weighted average under perpetual. The original use of this was for companies that sold a very high volume of a homogeneous product like liquid, oil and gas, any type of fuel, where the units would become mixed, right? So if you pull up to a gas station, they're getting a delivery, the tank's not empty. So there's some fuel that was purchased last week, and now they fill it up average. So it makes sense to do average. Today, that's kind of out the window, in a sense, because you use average cost sometimes for insignificant inventory or supplies in practice. The FIFO method, first one's in and the first one's out. And that's going to be, I think, the most logical method for most companies. And this is used for, well, first let me tell you that when you look at FIFO, it will assign the most recent cost to ending inventory, the oldest cost to the cost of goods sold. In a period of inflation, ending inventory would be highest, cost of goods sold would be lowest here, because you're going to have low cost being, in a sense, being your cost of goods sold. So you get more profit with FIFO in a period of inflation. The original use was for firms that would sell products that were subject to styles, changes, obsolescence, rapid technological change, and spoilage, which would be true of most companies. And FIFO actually approximates specific identification, because the unit flow typically matches the cost flow. What we mean by that is you are definitely managing your business on a FIFO basis. So when I was going to college, worked for Sears, the boxes were marked. If you look, you wouldn't know it, but if you looked at the price tag, at the sticker on the packaging, it would say S or R. It was Sears Roebuck. If it was S, that meant that the products were bought in the first half of the year. You better sell them first. If it had an R on it, it meant that it was more recent. And that would not be the one you would sell. So you would try to sell the oldest units first, and therefore the unit flow will definitely match the cost flow. It's also going to be the case that FIFO is a natural perpetual method. So FIFO Perpetual is the same as FIFO Periodic, as we're going to say. Now, these two approaches, along with specific identification, are acceptable for IFRS. The last one, LIFO, is not acceptable under IFRS. And as you're going to see, the only reason why LIFO is extremely popular in the United States was because of a ruling by the IRS, which was known as the LIFO conformity rule. I'll explain that a bit more. It was put into place when companies were doing the following. They were using FIFO on their books and LIFO for tax. LIFO would give them the highest tax write-off. FIFO would show their stockholders the highest profit. And I just pretty much showed you a few minutes ago, the method of inventory valuation has zero impact on cash flow except for taxes. So what does the IRS tell us? Well, from now on, if you use LIFO for tax, you have to use it on your financials. So as we said when we were discussing the theory early on in the course, I told you that you're going to find companies like Kellogg's, you're going to find companies like the New York Times using LIFO on their financials. It doesn't mean that they manage their inventory that way. It means that they're just following the tax rule. The other important point is that because we know that this is a distortion, and in fact, when you think about LIFO, it is distorting ending inventory. Profit-wise, it's probably sensible because it matches a direct association of higher cost of goods sold with higher selling price, right? So it kind of makes sense to use LIFO, but we are going to show you disclosures. And it's extremely important that you understand that there will be disclosures that will enable you to convert LIFO to FIFO. So we're going to get the best of both worlds. And remember, the idea of doing the balance sheet and income statement objectives and the trade-off with receivables is a first step, because we're going to do it here again. So that's important. And to let you know, LIFO is not permitted under IFRS. It's not permitted under international accounting standards. That's a key question that will come up on the CPA exam for sure. So, not permitted under IFRS. And the reason for it is, again, is it logical? I think we talked about this briefly when we covered some of those theories in the conceptual framework. When do you think LIFO makes sense? I mean, is there any cases where LIFO makes sense? What type of company would sell their newest units first? Is that anybody? No, they're going to get rid of the old ones because they got to get rid of the old technology. Was that? Talking about the newest unit. So you've got, let's say you've got a cell phone, you've got an iPhone 7 in inventory. You're going to sell that one first, right? I mean, you don't want to sell the newest ones, so you try to get rid of them first. What are you going to do with the old ones? Junk them? You got to get rid of them. Well, I think if you have them in stock, you want to sell. What if you have, take clothing, take food products? So, by the way, technology is going to be a little different, and I'll tell you why. With technology, you use LIFO to begin with. Prices up or down, trending in tech companies. Down. So they're going to use FIFO anyway. So that's why the question probably had to be modified. So you're right in a certain way.
Would you use if the company owns its own product? LIFO would be the best.
If the product is, well, yeah, if it's a uniform product that is not subject to any kind of spoilage, you can just mix them and sell them. Yeah. And a lot of times when you look at it, the example I gave you was mining. So if you're mining a mineral, throw it on a pile, you're not going to take it from the bottom, you're going to take it generally from the top. So LIFO can make, but it really doesn't make too much sense in most other companies. So that's why it is generally not permitted under IFRS.
You wouldn't be able to follow services.
No, unless service companies are using any of the type of supplies, and they may account for supplies on a average or a FIFO basis. You don't forget when you use for the IRS, when you sell securities, how do you know? Let's say you've got a portfolio of stock. How do you know when you sell it which one you sold? You can use FIFO or average. Under the IRS laws, when you report your gain on a sale of a security, you can use a FIFO or an average cost basis, unless you can specifically identify anybody. They would not use that. All right, so let's go into Module 2, and I'm going to use this as a guide. I'm going to come back to this because I want to be able to use the same example. So if you look on the very first page of Module 2, here's our illustration. Now I'm going to go back and use this as a guide. So we're going to do both periodic and perpetual. We're going to review periodic, but our focus will be on perpetual. All right, so here's a company that's got a beginning inventory of 100 units at $1. They buy another 100 units at $2. That gives them a 200 unit inventory at $300. They then sell on June 30th, 160 units. We don't need the selling price there right now. They buy another 100 units at $3, and total available was 300. They sold 160, so the ending inventory is going to be 140. Now, we're going to ask you to calculate ending inventory under weighted average, FIFO, LIFO, under both perpetual and periodic. So I'm just going to make a note here, and I'm going to say, just so we know, we've got 300 available, and the ending inventory is 140, and cost of goods sold is 160. So we're going to calculate the ending inventory and the cost of goods sold, and total available would be 300. Now, let's go first to periodic. And I'm going to tell you that under the periodic inventory system, the primary focus is ending inventory. Under perpetual, the primary focus is the cost of goods sold. What tends to be a little bit of a problem with the titles of the methods is that when we look at a periodic, we're calculating ending inventory. So remember, under FIFO, the periodic focus is ending inventory, so let's do periodic first. Under a periodic inventory system, FIFO would, again, try to calculate the ending inventory. Ending inventory is going to be the most recent cost, and the cost of goods sold would be the oldest cost. So let me go back here and show you that if I'm calculating ending inventory for FIFO periodic, ending inventory is the most recent cost. So I've got 140 units left, correct? So let's just make sure we know. Out of those 140 units, where do they come from? If the first ones in are the first ones that you sold, you're selling off the older units first. The newer units are coming from the bottom. So here's what's left. You should have 100 at 3, and you need another 100, or need another 40. It's going to be 40 at 2. So that's going to be FIFO. Again, hopefully, again, it's a review, but I want you to ask questions if you have any questions. So that we now have most recent cost was the September 30th purchase, 100 units at 3. Next most recent, May 1st, 40 units at 2. And the inventory, and I'll summarize this later, is 380. And the cost of goods sold, as we said, if we think about calculation, the cost of goods sold, we'll put the dollars here, there's the units, dollars, the amount available that we had was always at, it's going to be constant, at 680, and 600 rather, I'm sorry, 600. So in fact, if we go back to that, the goods available for sale, total cost is going to be 600. So you can back into the cost of goods sold by taking 600 minus the ending inventory. And the cost of goods sold is 220. So that is going to be the periodic system. Yeah. The good thing about FIFO is that multiple choice question, CPA exam, FIFO periodic and FIFO perpetual are the same. So FIFO is a natural perpetual flow. So that if we now move to perpetual inventory, we're not going to focus on ending inventory, we're going to focus on the cost of goods sold. First in, first out. Cost of goods sold will be your oldest cost. So let's go back to the base data. I want to show you on the information that we've got. If you sold 160 units, now perpetual system is real time, that's the difference. Perpetual system is real time, which means that when this sale takes place, it's going to be FIFO, meaning that first goods in and the first one's out. This 160 is 100 units at 1, and 60 at 2. Those are the ones you saw. And they're at that point. So 160, 100 at 1, and then another 60 units at 2. So if we go back and look at the result, we'll find out we get the same result we had before, so that the perpetual will give us an inventory of 380 and cost of goods sold of 220, exactly as we had it before. Just a different perspective. So for FIFO, you get the same result. And now we need to tweak that a little bit with the last in, first out, and the average cost. And as I said, the other example in module 1 is a periodic that you can use to review. But I think it's best that we do both. But any questions on FIFO? Any questions on FIFO periodic versus FIFO perpetual?
How am I calculating the ending inventory, like the 600? So on the both, I'm still looking at my total units?
Yeah, well, we still have 300 units, but the cost of those 300 units was 600 in total. So any other questions? FIFO, perpetual, FIFO. Okay, average cost. First, let's do the average periodic. This method will take the average for the entire period. The entire period. It is the ratio of the total cost of goods available divided by the number of units available. So your total cost of goods available is 600. Total number of units available is 300. Where do we get that from? We're going to go back to the sheet that I handed out to you so you can use it as a reference. If you notice right now, the bottom of the sheet, or the bottom of the table, I should say, is going to give you the ending inventory, I should say the total goods available, 600, and units available, 3, so the average cost is $2 per unit. Now, what is the flaw in a periodic system? Does anyone see a problem here? And that's why I wanted you to use this example. What's the problem with using the average year one?
Is it because you're using the whole year instead of just up to June and then
Exactly.
December?
Yeah, that's it. I mean, if you think about it, you're using a purchase in September 30th that did not exist when the sale took place. So periodic is flawed because it's using information, it's using units and prices in the calculation that did not exist at the point of sale. Especially with LIFO. Especially with LIFO. So in the LIFO periodic, as we're going to see, you would include this as part of your cost of goods sold, but that cost and those units didn't even exist on the day you made the sale. So periodic is flawed because, and it's incorrect because it's using data, pricing, units that didn't exist at the point of sale. So when we go back to calculate it, $2 a unit. This is back in module 2 on page 2. It is $2. That's the average cost. And the inventory, 140 units at 2 or 280. Cost of goods sold, 160 at 2 or 320. Any questions on periodic average cost? under the perpetual, the average cost becomes a moving weighted average. A new average is computed after each purchase, and that new average is applied to the next sale. So that when we look at the base data, again on the sheet that I handed out, the supplement, when you first start, and I'm going to put this up on the board in a second, but when you first start, the average cost is going to be $1 when you start. So kind of obvious, but let's put it there on January 1. Cost of goods available over the number of units available is $1. Next, we have a purchase on May 1. All right, so what have we got? Now you've got 300 available in terms of dollars. Number of units, 200. Now your average cost is $1.50. So the average cost moves every time you got a purchase. The average cost is going to move with each purchase. Just let that sit for a second or two, and let's see if you have any questions. Because you have to take the average of what you have in. So you've got the beginning plus the new purchase. So it's always, the average cost is always the ratio of the cost of goods available divided by the number of units available. I mean, obviously the average price on this package is $2, and the average price on this layer is $1.
Would it be pretty much simpler if I just say add 1 and 2 and divide by 2?
You can do that also, but the problem is it is a weighted average. It just happens to work out this way because the average is what? Because the number of units are the same. So that when you weight, it's always going to work that way here because it's.
So if you change the amount of units, it won't be the same?
No, because what are the weights? The weights are the number of units in each batch. So you can just try it. So let's just say, let's try that. Let's make this 200. Right? So that would be 4. Right? So now you have 300 units and you got 4. I don't think it would work. Let's try it. So let's assume let's just say it's 100 times 1 and 200 times 2. There'll be more weight on the $2 purchase, and then you got 300 units. You got 5. So now you're going to get a different number. Obviously, you get 500 divided by 300. It's going to be $1.67. Now you notice that the weights. These are the weights. The units in each batch weight the price. So the more units you buy at a certain price, that will move the average towards that. And that's a good point. You know, I try to make this simple by keeping the units the same, but it does, when you use simple numbers, sometimes it will present material that kind of gets you to draw conclusions that may not be valid. Yeah, so I'm glad you asked the question. So these are the weights. The more you buy at each price, the more weight on that. The average is 167. Good question. All right. Now, that becomes the price that we're going to use to cost out the cost of goods sold. So now, with that 160, or 150 rather, excuse me, with the 150, 160 is sold, cost of goods sold is 240, and the ending inventory, of course, would be 360, or what you could have done was simply taken another $1.50 and multiply it against the units in ending inventory or the 140. Got some questions on the moving weighted average?
So nothing changed between the two?
No, the average cost doesn't change now until the next purchase, which we'll talk about. It is going to change because perpetual is going to give you 240 of cost of goods sold, periodic is 320. Yeah, we're going to see the comparison in just a second. Now, there's one last thing here. I'm going to go back to the table. When you got the table on the other page, I just don't want you to keep flipping back and forth. I want you to focus on this. So now what happens is you got another purchase, you buy another 100 units at $3. So what you now have is going to be the ending inventory will now be 140 units, but the cost is going to add another 300. So that the ending inventory now, or the cost, the new average cost goes to 257. The average cost goes to 257. Or the other way to look at it, probably an easier way, is to say that now the ending inventory is 360 divided by 140. That's the new average cost, 257. And that's going to be used next time around, the next time you sell something. So the next time you sell something, that becomes your new average cost. So that is the moving weighted average. All right, one method to go. Then we're going to do the comparison. What about LIFO? LIFO is going to assign the oldest cost to ending inventory and the most recent cost of goods sold. Once again, periodic focuses on the ending inventory. Now, the interesting thing here, again, is periodic is you wait until the end of the period in order to record the cost of goods sold. So the ending inventory is going to be 140, and we're going to take the oldest cost of ending inventory. So going back to the table itself, you're going to have the oldest cost is going to be 100 units at 1, and then 40 units at 2, so that's 80. So the ending inventory would be the oldest and the next oldest. So that's where we're getting them from. So then going back to the solution, it's 180 for ending inventory, and the cost of goods sold would be 420. Now, what is going on here, which is kind of ridiculous, is the fact that in that 420, you've got the last purchase. So that if you were doing this on a FIFO periodic, it would include the cost of purchases that didn't exist when the sale took place. Let me just show you that. So if we were doing this on a LIFO periodic, we're going to say that we sold 160 units, and what I want you to look at is the fact that you're going to say last in, first out. So this is LIFO periodic cost of goods sold. It's going to be from the September 30th purchase. It's going to be 100 units at 3. But notice the sale took place when? On June 30th. You're going to be using $3 that didn't even exist at that point. And then the next most recent cost, you sold 160, would come out of the May 1st purchase. So, LIFO periodic, as we said, is flawed, theoretically incorrect, because it's using prices that didn't exist when the sale took place. Does anyone not capture that or see that? That you're actually using a $3 price that did not exist when you sold those units. And that's the flaw in LIFO periodic. Now, I'm going to show you LIFO Perpetual. LIFO Perpetual is very logical. It's going to eat up the units in LIFO order. So, when we do LIFO Perpetual, when you sold those 160, where are they coming from? Last in, 100 at 2 and 60 at 1. Now, you notice what happens with LIFO Perpetual. You're not taking advantage of what? Those higher prices. We'll talk about methods that will help you through that. You're actually going to have to pay more tax with LIFO Perpetual in rising prices, because you're going to eat into these older layers quicker. All right, so let's see how that works. Here's LIFO Perpetual. We're going to focus on the ending inventory and bring it up on the screen for you. Focus on cost of goods sold, I should say. So what we're going to do is now look at the point of sale. So the cost of goods sold now has to be at the point of sale. It has to be at the point of sale. So when you sell those units, the most recent cost is all of the May 1st purchase. That's the most recent cost. The next most recent cost is the beginning inventory. So now you're eating into beginning inventory at $1. Something you don't want if this is tax. If you're using this for tax, you probably wouldn't. There's different LIFO approaches you can use. So notice you eat into this base layer, or this old layer of inventory, and you're using the cost of goods sold of $1 for those units. And it lowers the cost of goods sold. It lowers the cost of goods sold. So LIFO Perpetual will have to calculate the cost of goods sold at the point of sale. And then, of course, always take goods available minus the cost of goods sold to give you the ending inventory of 340. So once again, the point is that you don't take advantage of the higher prices. Now remember, under the problem with, so again, if this is LIFO Perpetual, sale takes place here, last in, first out, got 100 at 2 and 60 at $1. Right, so you're going this way. If you have LIFO Periodic, last one's in are at $3, 100 at 3, the next most recent in your cost of goods sold is 60 at 2. So the problem with LIFO Periodic is that, again, you're using prices that didn't exist on the date of sale. Another question. If you're managing this company, and let's say you are, you probably wouldn't. There's another method which we have, which is called dollar value LIFO for tax. But what if you were using the straight up LIFO periodic for tax purposes? What would you do if you were at this point? We put this on the screen this way. Yeah, this way. What would you do at this point? And let's say you knew that prices were rising, and it's at the end of the year, and you knew you had sales coming up. How would you maximize your cost of goods sold? What could you do? You could buy more units or produce more units at higher prices. So in many cases, people would say to properly manage the business, you make that purchase. right? You make the purchase to try to maximize your taxes. What if you know that, you know, you're gonna have your sales of 160 here? To avoid liquidating those base layers, you could make that purchase. Let's say you got more sales coming up. What would you do? You might buy more units after that sale. Let's say you sold another 100 units here. You might decide to go out and produce more units at $4. Now your cost of goods sold is even higher. Right? So what if I did that? What if I said, well, you know what? I sold 160 units here, and I'm going to report at the end of the quarter on September 30th. Why don't I just do this? Why don't I just buy 160 units at $3? So instead of buying 100 units, I could buy 160 units at $3 and get the highest cost of goods sold possible. So periodic inventory for LIFO, and that's why IFRS doesn't allow it, because it winds up driving managers to make some bad decisions to try to get the highest cost of goods sold, lowest taxes. Why is that a bad decision? Because now you might be stuck with more inventory. And you have to pay for the insurance on the inventory. You know, a lot of you take supply chain classes, you know you have too much inventory in stock, right? You got to pay for storage, you got to pay for insurance, you got to pay for shipping, whatever it is. Now you've got all that inventory. So, with that said, you can see why LIFO is not really acceptable in most other countries. All right. So now for the comparison. Here's our sort of our scoreboard here. So let's kind of put this together. And whether you use LIFO Periodic or LIFO Perpetual, you're going to notice that, once again, we've got two objectives here. And I can put this on the screen also. It's also on the back of your handout. And the narrative below that explains what we're going to be talking about. So, if I have, whether it's periodic or perpetual, and you can see that we are, again, trading off this balance sheet or income statement objective. First of all, let me remind you that FIFO Periodic and FIFO Perpetual will give you the same result, because FIFO is a natural perpetual approach. The other important point, and let's use the perpetual. We talk about the trade-off. Okay, so the ending inventory for FIFO. You have a balance sheet objective. FIFO will give you ending inventory close to current cost. So it meets the balance sheet objective of valuing inventory at current or replacement costs. We know that the average cost falls in between the two. From the income statement objective, LIFO would give you a better matching, or as we call it, direct association. Higher cost of goods sold. Matched with higher selling prices. So you get a trade-off. Now, we're going to resolve that trade-off pretty quickly. We'll tell you about that maybe on Tuesday. All right, so balance sheet objective, best satisfied with FIFO because the ending inventory is close to current cost. LIFO better satisfies matching because you have to think about unit cost as an indicator of selling prices, correct? One would think that selling prices are going to be increasing if your costs are increasing. Now, weighted average falls in between the two. A problem with FIFO, I'm going to tell you, it kind of overstates profit, correct? Sometimes you might have heard this even in intro, that FIFO creates phantom profits by having a cost of goods sold that's too low. However, on the other side, when you look at the balance sheet, LIFO tends to understate ending inventory. LIFO tends to understate the ending inventory. And let's think about the ratios we had. If you remember the financial ratios, when you think about LIFO, what about the current ratio? Current assets divided by current liabilities. What does LIFO tend to do to that ratio? This is important because let's try to tie all this together even from week one. Lowers it, yeah, because it's going to reduce the current assets. Remember, we talked about looking at the first footnote that tells you what methods the company's with 1 second, the company's using. So LIFO tends to lower the current ratio. We're ignoring taxes right now, so you might have more cash, but you're not going to affect it. Yeah.
So, since it reduces the current assets, would that necessarily mean that it overstates the liabilities, or just reduces the assets?
We're not looking at the liabilities. The liabilities can actually be lower. She might be paying less tax.
Depending on
Yeah, so we're not ignoring taxes now. What you're going to see, though, it's going to, there's going to be enough disclosure. We're going to talk about the footnotes where you're going to be able to find out how much of this is actually understood.
but the liabilities aren't affected.
No, we're not. They are, not from the purchase side, because you're buying. If you buy inventory, your supplier is going to charge you X number of dollars per unit, right? They're not going to say what method are you using on your financials. So you're going to pay the same price no matter what inventory method you use. Yep.
Can you explain how on the matching director association,
Yeah.
how the costs pretty much go up and the sales go
Sure.
up?
Sure. If you're using LIFO, it's got to be in a period of rising prices for it to make sense, because Augusto, when we talked about this, and we talked about those cell phones and technology, you know that if you're facing declining prices, LIFO doesn't make sense from the tax. The only reason why you're using this is for tax. So if you're using LIFO, the presumption is your company and the industry you're operating in is facing rising prices. And rising costs, I should say, right? Cost of acquisition of materials, cost of inventory. If those are going up, those costs are leading indicators of your selling price. So we would expect your sales to be higher, your unit sales price to go up. To keep your margin at a certain level, you're going to raise your selling price. So with that said, you've got costs going up, reflected in a higher cost of goods sold, matched against higher sales dollars.
So can that compare to something like a company of like Apple?
Apple would probably be using FIFO because their technology prices tend to decline over time. Well, cost of, maybe you don't see it in Apple products because they come out with all these, but you know, you look at big screen, flat screen TVs, you know, $3,000 5 years ago, you can get them for $100 now. So the technology kind of will lower those prices eventually.
So compared to what it was, it's better.
Yeah, so overall, your prices of manufacturing go down. So the first time you're making the new iPhone, it costs them more, and then obviously it drops because that technology comes up, and you can get it cheaper.
So it doesn't really like how you pay like $3,000 like a couple years ago to get a platform, and now how like it's like still expensive to get it, but not for the time being. So is
Yeah,
that,
I mean,
is
the
that
price,
basically the overall?
relatively the price. What other ratio does LIFO bias? Well, we talked about inventory turnover. Inventory turnover, cost of goods sold divided by the average inventory. We're going to go back to these ratios in the cycle. So what does LIFO do to this? LIFO will, relative to the other methods, higher cost of goods sold, lower inventory, and that raises the ratio. So companies using LIFO might have a higher turnover. Now you have to remember, as I tell you on the handout, that these relationships and rankings only hold up if prices are rising and inventory levels are constant or increasing. If inventory levels drop, we have a problem which is known as a LIFO liquidation. So if your inventory levels shrink, it means that you're going to have to eat into old base layers of inventory and release those old units, unit costs, not actually the units themselves, but the unit costs. And that'll cause cost of goods sold to drop. Now, talking about footnotes, disclosures. There is enough disclosure, and this came out, I can just tell you the SEC originally said, no way, no how are you allowed to show your stockholders non-LIFO numbers. Now, we give you enough information that you can convert LIFO to FIFO dollar for dollar. So if you want, you could get the LIFO cost of goods sold, and you could also get the FIFO and the inventory. And we do that through something known as a LIFO reserve. So let me just clean this off, and you can see the next page, the LIFO reserve is really nothing more than the difference between the ending inventory under FIFO and the ending inventory under LIFO. Now, how do companies get this LIFO reserve? They manage their business under what method? If you're managing a business like Kellogg's, if you're managing a business, New York Times, internally, how do you manage your business? On a LIFO assumption or a FIFO assumption? FIFO. So you've got the FIFO numbers, you're only using LIFO because you have to, because you want to get tax benefit. So we've got the FIFO numbers, so what we do is report them. The difference between the ending inventory under LIFO, ending inventory under FIFO is known as the LIFO reserve. Sometimes it's called an allowance. So in our case, in our perpetual inventory case, the LIFO reserve is 40. So what would happen is that internally, the company would have the following. So it would have inventory, and internally they'd have FIFO. And that would be 380. At the end of the year, they'd make an adjusting entry. sold here as well. So, and also, all right, so right now you're managing your business under the FIFO method. So you're running inventories, we make sure you have the right numbers, would be 380, the cost of goods sold would be 220. To convert it to LIFO for financial statement purposes, you make this adjustment. The adjusting entry debits the cost of goods sold and credits the reserve. So that would bring the ending inventory on the balance sheet. The inventory reported is 340. So, in order to get the LIFO, we use the LIFO Reserve. Now, the footnotes will disclose this, and you will be able to convert. So if you went to the footnote, you would find the LIFO Reserve. If you went to the footnote, you'd find it. So this company internally is under FIFO. Make an adjustment, higher cost of goods sold, lower inventory. Now your financial statements are under LIFO. But in the footnotes, we give you enough information to convert it. So I'm going to give you that $40. So you're going to know how to convert it. So you can adjust all those ratios. And that's known as the LIFO Reserve. It'll also tell you that if you want to adjust cost of goods sold, it's the change in the reserve. The change in the reserve is known as the LIFO effect. Change in the reserve is known as the LIFO effect. And I'm going to give you another example to show you that. So the footnotes would disclose the following. It would disclose the 40. So if you went to the balance sheet, let me just leave you with this. You'd see the LIFO ending inventory of 340. And if you went to a footnote, the LIFO reserve is 40, what could you do? Add the reserve back, and you'd get the FIFO inventory. So if you take the footnote, add it back to the balance sheet, you get the FIFO numbers. So you can convert it. Now we'll see more of that. Actually, we're going to go through some footnotes. In one of the modules, we're going to spend a little bit of time doing this, and I'll show you how to convert it. All right, so the LIFO reserve. All right, so I'll see you on Tuesday.